Do you know not all ETFs are created equal? Some can be risky, while others are safer. Some may focus on capital gain. Others are looking for dividends. When it comes to investing, we all have different goals. Ultimately, we would like to grow our wealth and get paid regularly. Now let's explore one of the most popular dividend ETFs, SCHD. It has performed very well in the past decade. In this video, we are going to see why SCHD is a good option for dividend investors, share some facts about this ETF, and how far we can go with investing $100,000 in this ETF. Now, let's quickly go over what ETFs are. ETFs stands for Exchange Traded Funds. An ETF includes a basket of stocks, bonds, or commodities. Instead of buying stocks or bonds separately, you can invest in one ETF that holds them all. This approach is cost-effective and reduces risks. Similarly, dividend ETFs are tracking stocks that pay dividends monthly or quarterly. You can build a diversified portfolio with just one investment. This saves your valuable time in picking individual stocks and minimizes the impacts if one stock performs poorly. Schwab U.S. Dividend Equity ETF, known by its ticker symbol SCHD, has consistently performed very well over the years. Sponsored by Charles Schwab, this ETF was introduced in 2011. Its benchmark is Dow Jones U.S. Dividend 100 Index, which currently tracks 104 large-cap value stocks, with assets totaling $53 billion under management. Impressively, the expense ratio is only 0.06%. The dividends are distributed to investors every quarter. Now let's see what sectors SCHD invests in. Industrials at 17.1%, financials at 6.7%, healthcare at 15.9%, information technology at 12.6%, consumer staples at 11.9%, energy at 9.2%, consumer discretionary at 8.2%, communication services at 4.3%, materials at 3.6%, and utilities at 0.4%. This diversified mix of dividend-producing stocks spans various industries, providing us with exposure to different sectors of the economy. Notably, information technology has experienced high growth over the years while still maintaining the ability to distribute and increase dividends annually. Industrials, healthcare, communication services, materials, and utilities have demonstrated stability over the years. Financials, consumer discretionary, and energy are all closely tied to the economy, so it has its ups and downs. Overall, with this diverse combination of sectors, we have the potential of growth and dividends. It is the best of both worlds. There are thousands of stocks that are paying dividends in the market. How did 104 dividend stocks make the cut to the SCHD portfolio? We have 2 rounds of the selection process for dividend stocks to make the list. Round 1, companies must meet these 3 criteria: a minimum of 10 consecutive years of dividend payments, the minimum float adjusted market cap of $500 million, and the minimum 3-month average daily volume traded is at $2 million. Following this initial screening, the second round evaluates companies based on 4 fundamental characteristics: cash on hand compared to debt, profit compared to the investment, dividend yield, and the past 5-year dividend growth rate. Finally, the top 100 ranked stocks will be selected. By implementing such a strict selection process, you may wonder if SCHD is unbeatable. Let's take a look at the return of SCHD compared to the market, also known as S&P 500. Now we pick SPDR S&P 500 ETF Trust, ticker symbol SPY, to represent the market. From the chart, we can see SCHD performed better than SPY from early 2022 to early 2023. But from early 2023 to present, SPY outperformed SCHD. Why did that happen? Now take a look at the top 10 holdings in each fund. As we can see, 9 out of top 10 companies in SPY are in the tech sector. but only 3 out of 10 companies in SCHD are in the tech sector. Overall, the tech sector comprised 12.58% in SCHD, but 27.16% in SPY. As a result, the price movement in the tech sector has a bigger impact on SPY than SCHD. As we can see in this chart, in 2022, tech stocks dropped 31.2%, so the S&P 500 also dropped 18.1%. How about SCHD? It only dropped 3.23%. So, that explains why SCHD had a better return in 2022. Then, the tech stocks had a huge return of 57.4% in 2023. So the S&P 500 also increased 26.3%. However, the tech sector comprised a much smaller portion in SCHD than in SPY. Therefore, SPY outperformed SCHD in 2023. Since the fund was introduced, there has been a positive correlation between SCHD and the S&P 500. So SCHD is expected to continue to have this trend in the future. There are 4 reasons about SCHD that you would like to hold on for a long term. Reason 1. Low expense ratio. SCHD charges only 0.06% of what you invest in. For an investment of $10,000, you would pay a $6 annual fee. Please don't overlook this expense ratio. It can significantly impact your return over time. To put it in perspective, imagine another investment charging 0.6%, resulting in a $60 annual fee for the same $10,000 investment. Unless the return is substantially higher, paying 10 times in fees doesn't make sense. So, a lower expense ratio is preferred. Additionally, Charles Schwab reconstitutes the fund every year on the 3rd Friday in March. All stocks on the list have to meet these criteria. Also, individual stocks are no more than 4% of the overall portfolio, and each sector is no more than 25%. The underperformed companies will be replaced and new holdings will be added. So, this is not just simply a low expense ratio, but a level of quality assurance. Reason 2. Let's see what is inside SCHD. There are 104 companies in the fund. So, investing in this ETF means you are investing in 104 great companies in the market that have at least 10 years of dividend-paying history, and they have the potential to continuously pay dividends in the long run. SCHD is a good offensive player. The fund includes companies like Broadcom, Texas Instruments, Cisco Systems, made up of 12.58% of the portfolio. AI is still at the early age. These companies are expected to grow in the near future with AI. SCHD is also a good defense player. Companies like Merck, AbbVie, Verizon, and Coca-Cola are known for their resilience during economic downturns. In tough times, people still need their products and services. As investors, we would like to see the fund thrive in the good times and also demonstrate strong defensive capabilities during challenging economic conditions. Reason 3. SCHD has growth in dividend and share price. Now, let's calculate the return from yield on cost, which measures how productive an investment is. The formula is dividing the stock's dividend in the current year by the price when in purchase. This is a measure of dividend yield based on the original price paid for. Let's say you purchase a share of SCHD for $26.30 back in 2012. In that year, you would receive 81 cents in dividend. So your yield on cost is 3.08%. In 2017, the annual dividend grew to $1.35. So the yield on cost is 5.13%. How about in 2022? You will receive $2.56 in dividend, so the yield on cost is 9.74%. Furthermore, a share of SCHD was at $74 in 2022, so this is almost 3 times of your initial investment. If you reinvest dividends, you would have much more shares of SCHD, which results in more dividends. $26.30 you invested in 2012 would be $100 10 years later. This is almost 4 times of the original investment. You are earning dividends every year on top of the share price appreciation. Reason 4. SCHD is a very low risk in the long run. Warren Buffett said, "Risk comes from not knowing what you are doing." For individual stocks, we may need to know a lot about the specific company or even the industry, but ETFs provide us with a well-diversified portfolio that has a very clear goal, in which placing your investment at a much lower risk. Let's take a look at the top 10 companies again. They are taking over 42% of the portfolio. These 10 companies are in 5 sectors. In any economic environment, there is a very low chance that all 10 companies would cancel dividends or even go bankrupt at the same time. The chance of all 104 companies not doing well is approaching 0. With 2 rounds of selection process plus reconstitution every year, SCHD is able to reduce risk and maximize earning very well. Now, let's see how far we can go if we invest $100,000 in SCHD. In 10 years, your investment would grow to $333,110 with an annual dividend of $11,823 or $985 per month. This can improve your quality of life. In 15 years, this investment would become $653,112 and the annual dividend is $23,754. This is equivalent to $1,980 per month. This dividend can fund a nice vacation overseas. SCHD stands out as a compelling investment choice, offering both growth potential and consistent dividends. Its rigorous selection process ensures the fund maintains a strong performance within the market. With a negligible risk profile, SCHD provides stability for investors across various risk appetites. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.